bigger head than me.
You stretch that thing out?
Yeah, I think so. It's not good. Like germ infested everything. I don't want to get sick.
Wipe that thing down.
Right. I clean the headsets. I try to clean them at least twice a week, so just so y'all know. I wipe them down pretty good.
All right, we got about 1 minute, so the song has 2 minutes remaining. So.
Okay, so go ahead and do, go to manual, go to where it says auto DJ and hit manual DJ. And then as soon as that song ends, you're gonna hit the lock talk button at the bottom. And then when we get ready to, yeah, you're just gonna hit it right there when you're ready. And then when your session ends, the first thing you're gonna do is hit the lock talk to take that off, and then you're gonna hit this button right here to start the cue to play, and then you're gonna go hit auto DJ, and then we'll go back to the, and then we'll turn the Facebook off. Okay?
Okay.
Okay. What are y'all talking about? Give me a heads up.
Credit.
Yeah.
Oh, I love credit.
Love getting credit.
So we've been building an audience here on Facebook Live. We're up and we're soft.
We're going.
Hey, Facebook Live. This is Derek Taylor and Patrick McCarroll and Connie Little, and we're going to do Welcome Home with Derek and Patrick, a real estate radio show. Thank you for joining us. This is my first time running the board, so you'll probably hear Connie yell at me something like, "No, don't do that." It's probably too late at that point, but anyway, it's going to be fun. We're going to talk about credit and how credit can affect your ability to purchase a house and what you can do to make sure that you've got that under control and you're watching it and making it better. So we're running up on 43 seconds before we go live on so when that hits 0, I just push that button and we're good.
And you're good.
All right.
Boom.
This is exciting.
Simple. Mm-hmm. It's a little intimidating, but not too bad.
I hope I don't break any laws.
You look a little intimidated.
No.
My old lady, did you see that?
Any FCC laws. 19 seconds.
Then we're going to go live on the radio. It's going to be awesome. I have a t-shirt that says I'm awesome.
You do?
I do. I bought it just because it said I was awesome. I needed a reminder.
Ready? 4, 3, 2.
You're live.
Hello, Joko Radio. We're live. This is Derek Taylor and Patrick McCarroll and our special guest Connie Little here helping me run the board and learning about how this radio works.
You're good?
We're good there?
Yep,
On the
you're
volume?
awesome.
Okay,
Yep.
cool. Hopefully y'all can hear us.
Yeah. Yeah, I can hear you.
All
Can
right.
you hear him? Can
I
you
hear
hear
him
him,
just
Patrick?
fine.
Yeah,
You
we're
can
good.
hear us? Hey, it's working.
Yeah.
I'm doing it, y'all.
I'm so proud.
This is so exciting.
Great moment.
We should have a cupcake and celebrate.
I like
I don't
cupcakes.
have any. Don't worry about it.
Don't tease me like that.
Mm-hmm.
Well, good. So today we're going to be talking about credit and how credit can help affect your entire life, but especially the purchase of a home and what that can do to you financially, how you can overcome any problems that you may have. And today we're going to listen to Patrick talk a lot because Patrick is our resident expert on credit. He knows exactly what he's talking about. So Patrick, just to kind of kick this off, so we're talking about credit. What is the difference between a credit report and a credit score? What are people looking at? What are we talking about here?
So obviously a credit report is kind of a map of your credit history. The credit score, believe it or not, is somewhat of the third party's acknowledgement of this is your level of risk. This is a risk-based score. The higher your credit score is, the least amount of risk. The lower your credit score is, the higher the risk is for anyone who's extending good credit.
Okay. All right. So and you've got what constitutes a credit report or a credit score, and are there more than one?
Yeah, there's 3 different credit bureaus that report to a credit agency. Now, not all lenders utilize all 3 because there's an expense associated with getting that information from said 3 bureaus. There's Equifax, there's Experian, and there's TransUnion. So those are the major 3 credit repositories in the United States. Each one follows the Beacon Endor FICO scoring system, which is a mathematic model attached to the mixture of your credit. I think you've got some slides there. But the credit score is determined based upon 35% of your credit score is your payment history in the past. You know, how you've managed your debt. Has your debt been on time? Have you paid it on time? Have you had late payments? Have you had collections with medical companies, electric companies, phone companies, what have you not? Which obviously that's the highest part of your credit score. The next one is actually a little bit particular. 35% is the payment history, but 30% is the utilization rate, which is a lot of Americans don't understand. Within 5% of your payment history is...
Is that
Who's
me?
that? Somebody's talking to us. Is that your phone talking to us?
That was British Siri.
It's like,
Wait, do we have like a James Bond voice for
Yes,
your
I
Siri?
have James Bond Siri. Yeah.
How do you even pull that off? I don't even know how to... You got all these awesome gadgets. I don't even know what to do.
And you can have him call you whatever you want. So it changes
I
from
don't even know if I want to ask what
007
they've got
to
007's
King.
calling you in the car.
do
Do you?
in the morning, do you say, how's my day? How do I look today? Tell me
Do
how
you ask
awesome
your-
I am
your
today.
British Siri that question?
Yeah.
No, because he doesn't care.
Oh, he doesn't
No,
care?
he doesn't really care at all. No.
He doesn't respond back and go, you look amazing.
It's funny because Siri, whether he's British Siri or regular Siri, doesn't seem to really care much about you personally.
Really?
Yeah, I don't know why. I guess maybe
Nor does he care about your credit score then.
he doesn't as much as he should.
It doesn't appear that way. So getting back to the utilization rate is said credit card company says you've got $5,000 of accessible credit. And the utilization rate is how much of that 5,000 are you currently utilizing. So you could have a situation where you have paid every liability in your life on time. Constantly, you've never had a late payment. But if you have 15 open accounts and you are utilizing 75% of the credit limit on all of those accounts, it can be equally as detrimental as if you've had late payments in the past. So your credit score could be dramatically reduced because you're considered to be overextended on your credit limits.
So break that down for simple people like me. What you're saying is, if I've got a $1,000 credit card limit and I've got more than $750 on my credit card, then I'm overutilizing my available credit, and it's going to affect my score
You're
negatively.
maxing yourself out. Absolutely.
Really?
Yes, so it's kind of a percentage of 25, 50, 75 is kind of the rule of thumb. Meaning if you've got a $1,000 credit limit, the optimal place to be is $250 or less in an active balance. Once it goes above the 250, there's a credit hit. Once it goes above 500, which is 50%, another hit, and then once it gets over 750, which is 75% utilization, it's like a financial sledgehammer. So it depends upon, again, the mixture, which is certain other aspects. 15% is the type of history you have, 10% is if it's new credit or what have you not. But the utilization rate is far more impactful than what most of us give credit for.
And so what is it that you should not go over on your
25% or less is where you want them to be.
So if you consistently charge on your credit card a certain amount every single month, just raise your credit limit so that it balances out.
Correct. That
Got
would
it.
work as well.
Okay.
So I'm just going to cut up my credit cards, then I'll never have to worry about that,
That's
right?
a good idea.
And
No,
then
that
close
affects your
and
credit, doesn't it?
close my account, right? I should
Well-
close my account.
To a point, if you ever wanted to, now to your point, yes, is it can be equally as detrimental to have no credit whatsoever. It's kind of this weird catch-22. Our team will have people call in all the time, and they just have made the choice that I don't want to be a part of it. They've either gone through a Dave Ramsey, which we've all talked about on this show a couple of times, of we don't want to have all this credit established, but it's a catch-22. When you go for something like a mortgage, if you can't show or demonstrate a credit history, well, then you're denied there as well. So it's kind of one of those thought processes of, I got to go out and get credit to
Yeah.
get other credit. That doesn't make any sense, but that's absolutely right. So you want to have some things that are open that display some form of a credit history.
Okay, so the history is really, really important.
Yes.
All right, perfect. So don't go out there and close all your accounts. I've actually had people who did that, that were getting ready to purchase a home, and they waited a couple of years, and they had no payment history in a couple of years. Now that would seem like it was a great idea, but it dropped their credit score substantially.
We've lightened up quite a bit on that since the credit crisis. As soon as the credit crisis hit, the rules had changed where you had to have so many open trade lines to be considered a credit-worthy borrower. So we've kind of swayed a bit from that to where if you haven't had something open for a year or two, there's still performance history in the past. It still impacts your score because you don't have that 30% utilization rate to formulate into it. But you still can have a score. It's just probably not as good as you'd like it to be.
Right. Okay. So one of the reasons why we want to bring this up is because the information that's on your credit report can impact your credit score for up to 7 to 10 years.
Mm-hmm.
And this is an interesting statistic. I just threw it up on Facebook Live. 37% of adults do not know their credit score, and only 39% of adults have ever obtained a credit report. So that is almost alarming to me, especially the last one. The first one, not knowing your credit score, that's not good. But never ever looking at your credit report, I think that's even worse.
So the market makes it difficult as well because the FICO and Beacon scoring systems are patent mathematic formulas that nobody else can come in and duplicate because it's owned by the FICO and Beacon system. So you have the Credit Karmas, the online places that you can go. Well, because you can't follow the exact model of the credit scoring system, you have to create your own model. So you try to get something that's remotely close. So it's like you can't completely duplicate Coke, but I want to get something as close to Coke as possible. And that's what those guys do. But we had an example the other day which kind of makes it dangerous back and forth is this gentleman, was talking to Ashley and one of the online credit agencies said his credit score was a 755. Well, by the time we did our investigative side and our more intense credit pooling system, it was a 685. So sometimes can be a pretty big difference from the online version to what your actual credit score is.
Mm-hmm.
So that's actually the first time I ever heard that. Mm-hmm. So your online credit score is going to differ to what your actual credit score is?
It's probably almost always going to be...
So like 100 points or what?
Sometimes it can be as many as 50 to 100 points higher than what a representative score would be in a tri-merged, all three put together system.
Okay.
That's a bit more detailed.
So it'll be higher but not lower?
Yeah.
That's a good thing.
Yes.
Because you want your credit score to be as high as you can go. What's the highest you can get your credit score to?
850, somewhere around that range.
The official...
Never seen anybody with it ever.
I read this the other day. The official range for a credit score is 300
to 900.
To 900. Yeah.
Oh, that's the official range. I thought you were going to go. Yeah,
no,
never mind.
300 to 900.
What's the average? The average consumer. What is their average?
That's a really good question, Connie.
Hey, thanks. That's what I'm here for.
We have that graphic for that. Let me show you.
do.
I just popped it up on Facebook Live.
I love it.
So it depends upon your age. So the average credit score by age group, if you are 18 to 24, you are averaging. They are averaging a 620 credit score. 24 to 34 averages a 640 credit score. 34 to 44 is a 644. 45 to 54 is 664, and 55 plus is a 700. And those are Experian numbers from Experian.
Are those nationwide?
Yes, nationwide.
That's interesting.
And it is interesting because every one of those average credit scores qualifies them, by credit score at least, to purchase a home.
Mm-hmm.
Which means that the average person can purchase a home.
Yes.
Which is kind of cool.
And at a reasonable interest rate
Yeah.
as well.
Mm-hmm.
There's nothing but reasonable rates right now.
I know, isn't that cool?
I mean, you got to be borrowing from the loan shark down the road, and you're still going to get a pretty decent rate probably right now.
The interesting part about Texas is no one's ever been able to really put an answer to this equation, but Texas has historically always been in the bottom 5 in the nation of average credit score consistently year over year.
Really?
We manage our debt a little bit tougher than most every other state
That's awesome.
in the United States.
So we're one of the lower credit scores?
One of the lower average credit scores in the country, statewide.
That might have changed a little bit last year because I pulled up, I don't think I brought it with me, but I pulled up a report on that in Texas. They had it color-coded. It was a color-coded map, and Texas was in the blue with most of the country. And there were about 6 or 7 in the red. So we might have pumped up a little bit. Way to go, Texas.
For sure.
Yeah, that would be great. We needed it. All right, so couple of things that you can do if you're looking to purchase a home right now or in the next year. What should you not do, and what should you do to keep or maintain your credit score?
If you're entertaining a purchase, obviously avoiding new debt is a great idea. Again, because of that utilization rate. So if you're halfway through your car, you know that utilization rate's at 50%. You know, you're going to have a good score based upon that. But if somewhere 3 months down the road you decide I'm going to go get a new car, well, that's going to report to be maxed out. That utilization rate's going to be over the 75%, which potentially could bring your score to either a worse interest rate as a result, or you know, put you out of a qualifying range of a program or what have you not. So if you have the idea and the thought and the passion to be a homeowner, I would put a freeze on new debt for sure, and then I would work on the utilization rate on the areas you can. Now, obviously, you can't go pay 75% of your car off or what have you not, but the credit cards, the other mixture of debt, any small installment loans, any credit cards, start to work on getting that 25 to 30% balance range, which would certainly improve your score whenever you're ready.
Yep, that's great. I had a client that called me. He had moved away, and he's got this kind of job that he moves around a lot. And he's getting ready to move to a new city, and it's going to change the way he drives. So he said, look, I'm going to be moving in the next few months. I want to go ahead and trade my truck in and get something new that's got better gas mileage. Should I wait, or should I do it after I purchase? Should I do it after I purchase, or can I do it now? And my advice to him was to do it after he's made the purchase.
Absolutely.
So how long do you prepare to purchase a home? So you're not going to buy anything for 6 months before you go to purchase a home? Is it a year? What do you suggest to people? What do you tell them?
I would say a complete freeze once you've made the decision that this is the step I want to take. Just simply because you can work on those rates, the payment performance is there. As Derek had a slide there, new debt sometimes can worsen your credit score. So if you've got that goal, the goal is to kind of start with somebody, see where you are, and then freeze everything from that point, work on either improving the score to where you could have a better interest rate. Because in a lot of ways, we'll have consumers come in, and in the mortgage market, they have what's called loan level price adjustments, okay? And what that means is your credit score contingent upon how much you want to put down. There's a matrix that is a risk level matrix that says, okay, if you've got a 660 and you're putting 5% down, well, your interest rate increases by this. But if you're a 680, it's not as impactful based upon the amount that you're putting down. So what we'll see is there's times that we may have to wait a month or two because we'll pull the credit and we'll have an idea of, well, we might be able to improve this by 20 points to get a better interest rate if you could take $1,000 over the next 30 days and specifically go do this right here. So we can direct you exactly what to pay down, exactly what to pay off, and it'll put your score exactly where you want to be to get the best borrowing power available.
That's awesome.
Yeah,
So y'all are actually going to teach them how to do all this. Like if somebody comes to you and they don't even know what a credit score is, you can help them pull their credit score through like Karma. What is it called? Credit Karma?
We'll actually do a real tri-merged
you will.
credit report, yes.
Is there a fee for y'all doing that?
No.
There's no fee.
fees.
That's awesome.
Yeah, so and we'll kind of get there. I think what we'll start off with here is if you have great credit or you're ready to buy, what should I not do? And then we're going to lead a little bit after that into, okay, my credit is so-so, what can I do to get it a little bit better?
Right.
And then the last one is my credit is horrible, at least I think it is, and I need to really work on it. Then we'll kind of talk about some other issues you can do, but everybody needs a plan.
Right.
Somewhere to start.
Yep. The biggest thing you need to know, number one, is where you are. If you don't know where you are, you can't know where you're going, and you'll never get where you need to be. So that's what we talk about here is kind of beginning the journey, and everybody starts at different places. So, but it doesn't mean you can't get there. One way or another, you can still get there. It's just how you just may be further away than you thought, but we can get you closer. And I would be surprised. The majority of people think their credit is worse than it really is.
Most everyone who comes in thinks it's a bit worse than what it really is.
That's crazy. So if somebody comes in tomorrow and they say, okay, we want to move at the end of the school year. So we want to move over the summer so we can get into this new school district. And their credit is like, say, 500.
Well,
So you're going to work with them over the next 6 months to where you can get their credit
We
built
can set
up?
them up on a detailed battle plan of attack this, do this. In some cases, it's a 500 because of things that have happened in the past. But sometimes whenever we've gone through bad occurrences as human nature, we want to act like an ostrich and we want to put our head in the sand. You know,
Right.
we want to
Right.
pretend as it's not there, and maybe one day it'll kick under the rug and it just doesn't exist. So we stop and freeze
Right.
everything. Well, that freezes the picture all the way through. So sometimes it's just the advice of go out and get a couple of department store credit cards, you know, whatever the limit is, kind of stay within this payment range, work on this for 4 to 5 months, and the score will go up 100, 120 points in most cases.
Oh, that's awesome.
Mm-hmm.
Yeah, very cool. Thank you.
So you're ready to roll. You've got the okay from your mortgage broker, and you're ready to start the purchasing process. Here's 4 things you should not do. Number 1, don't change your job.
Yes.
So don't
That's probably good advice.
Yeah.
Mm-hmm.
and if you're in an apartment, don't move to a new apartment. I know that sounds a little weird, but a change of address as well as a change in job can affect your credit score.
Mm-hmm.
Set up and make sure that you have a calendar notification to remind you of every single bill that you have coming up. And you want to make sure that you do not miss one. Make sure they're all paid on time. Make sure you still have a little bit of debt that you're paying off, but not too much. Don't go over 25% utilization. And lastly, don't be a credit junkie. Don't start using your credit to buy furniture before you bought the house.
Right.
The 2 worst mistakes I've seen people make before they move in is to go out and buy a bunch of furniture or a brand new car before they close. And sometimes they have to repull credit.
Well, it's not a repull. Well,
Or-
the mortgage market has gotten really smart. A lot of people don't believe that we learned a lot of lessons through the credit crisis, but we did. And one of those major lessons is kind of going back to the report. A lot of us don't understand that your payment history itself, not just the payment history of whether or not you've been on time, when you haven't been on time, you know, where it marks 30 days off. There's your guy again.
I turned him off.
This is great.
He wants to be in part of the
He wants to be part of the conversation. Put him up to a microphone.
He says, go ahead, I'm listening.
Put some headphones on.
So, and then he says, I can't close the pod bay doors. How?
That's hilarious. That's hilarious. His
that's
comic
funny.
relief on the show today
Right?
is Derek's phone
That's
and his guy talking to him.
That's funny. This is a serious situation here,
Serious,
and
serious.
Hal
This
wants
guy's
to be a part
jumping all
of
in.
it.
Okay, he's officially powered off.
Take me
Okay.
apart. But a part of the credit report is it's always been, you know, dates of, you know, C is it's paid on time, and then there's a 1 that's 30 days, and that's all that the credit report would say. Well, one of the things is that the credit report now specifically states what you pay month after month for a 24-month basis. So if you're somebody that's got credit cards and it's registering that you're just making the minimum payment each time trucking along, those are things that are looked at and reviewed in underwriting. So it's detailed kind of how, as much as what you pay on a monthly basis. So I can see that you paid $100 2 months ago, you paid $25 this month, or you don't ever really try to get the balance down at all. And underwriters actually look at that when they see if your debt to income ratio is too high. They look at your utilization rate, they look at what you're actually paying, and that's actually looked at in the overall credit quality. So that's the first thing to think of. And what you're talking about is during the credit crisis, when loans went into foreclosure, everybody started auditing them and looking at kind of what was going on. And what they noticed was that exact scenarios. We got into a mortgage the day of closing, days before. People went out and bought a bunch of furniture, went and bought brand new appliances, refrigerators, what have you not, and they increased their debt by $200 a month. Well, that increased debt was never introduced into their qualification ability, their debt to income ratio. So it was kind of deemed that failure from the start, that they went out and got debt to the point that it affected their ability to pay the loan. So they created what's called debt monitoring. So when an underwriter, the final decision maker, gets your file, they automatically put you into an automated system, and that automated system registers anytime something happens to your credit. So if somebody pulls your credit, if your balances change, if you have a late payment, anything from the date that they put you in to the day that the loan funds tells the mortgage company.
Okay.
So if you run out the day before closing and you go to Lowe's because Lowe's has a, spend $5,000, get 10% off sale, and you have Lowe's pull your credit, it will completely stall the entire process until you can determine whether or not a new debt has been established, because that debt has to be introduced into your
Yeah.
ability to qualify.
So when people go out and they're looking for new cars or homes or whatever, and the people say, well, let's pull your credit and see, that affects you as well, right?
That'll affect because it'll show as an
So
inquiry.
don't do that.
So don't do that. Yes.
Know your credit score before you go out and make a purchase on anything. Got it.
Yeah, is there really such a thing as a hard hit and a soft hit?
There is true. So an example of a hard inquiry is when you're having your credit pulled solely for the purpose to accumulate debt, to get some form of credit trade line. A soft pull is when your insurance company pulls it just to look at your score to see what insurance policy that you're going to get, or AT&T pulls it when you're trying to get a new phone, that kind of stuff. Those are soft pulls. But the hard pulls are you're trying to get a credit card, you're trying to buy a car, you're trying to buy a house. Those types of things.
So
So-
the hard pulls are the ones that report to
Those
the
are the ones
credit.
that get
Okay.
you. Yep.
Sorry.
That's okay. Yeah, I was gonna say I had a client that was looking there at the end of their lease right before they closed, and on their car, and so they went to the car dealership, and the car dealership told them, "Oh, don't worry, we're just gonna do a soft pull to get you qualified," and
Yeah.
it was not a soft pull.
No.
It's not a soft pull.
It
No.
didn't. They were very, very lucky that it did drop their interest rate, but not enough to put them in the next tier.
Yeah.
So, and I called them. They called me and hey, we're checking on the deal. We're at the car dealership right now, and I said, don't do it,
Right.
and they did it anyway.
Yeah,
But-
I had a friend of mine that was
Yeah.
going to car dealership to car dealership, trying to get the best deal, and they pulled six. He went to 6 different car dealerships, made 6 inquiries, and dropped his credit score so low that he
Yeah.
couldn't even qualify for a car loan.
yeah, that's not right.
Yeah, that was years ago, but yeah, it happened.
They've
They
changed.
changed that a little bit. I mean,
Yeah.
it's not as impactful.
Right.
You have the right to go out and hunt for what would be classified as the best deal. So you have up to 8 inquiries within a 30-day time span of the same type of financial institutions before it starts to supposedly negative impact your score. But
Right.
in those scenarios, the problem is most of those car dealerships have 2 and 3 and 4 different banks that they're going after. So they're multiple different pulls are happening within the same car dealership. But that's what makes it tough.
That's so
Yeah.
crazy. But that affects you if you're trying to buy
It
a
does.
home. That's totally going to affect the bottom line.
It does.
So don't do that.
Don't do that.
Yeah, yeah.
Well, so we're past our break. We need to take a break and pay some
wanna take a
bills.
break?
Yeah, how do we do this, Connie?
Let's
What
take
am
a
I
break.
doing?
All right, we're going to take a break. Facebook, we're still here, but you're going to listen to a song on the radio for just a moment. So hit that. Hit Lock Talk right here. Turn that off. Go up here to Auto DJ. Done. Now you're playing. Oh, hit the key right here.
That?
Yep. Okay. Done. Now you're playing a song.
Oh,
Okay, so you got about 4-minute break. Now, before that song ends, you're going to go back to manual DJ, and then when you're ready, just hit Lock Talk again.
Hey, all right. So while we've got, we're taking a little break. We do have Becky Everett Patrick, who asks if Credit Karma is a good tool to use for credit scores. What do you think, Patrick?
To track, yes, it's not going to be the final credit score. I mean, you're probably going to have something a little bit lower, but Credit Karma was actually the example that I gave that it stated the score was a 755, but it was a 685 once we pulled it. So there could be some differences there, but it's a good thing to track to see what's on it. It's a good way to get a copy of your credit report to see your utilization of what your current balance is compared to the high credit limit. Like Connie said, sometimes if you don't have the financial capacity to pay the accounts down, you can call and request for the credit limit to be increased, not to use it, but to try to get that separation of utilization.
So, correct me if I'm wrong, but when you pull your credit, won't you be able to print out like a credit report that shows you all of your credit cards, your house, your cars, whatever you owe money on, and even things that have been paid off, right?
Correct.
Okay, so that's a
Correct.
good tool. Print that out and keep it and highlight those things because
Yep.
there could be things on there that are not yours.
Absolutely.
So you may have to dispute those to get those off so that you raise your credit score that way as well.
And there's a lot of times there's things you just don't know about. The
Right.
worst thing is medical collections. And I mean, 85% of Americans have some form of a medical collection on their credit
Yeah.
because something gets supposedly put in the mail. It looks like junk. We all throw it away because you've all seen those ones that come across from medical companies. It looks like a trash piece of mail, and sometimes I think they do it intentionally to kind of get you in a bad spot with the account. But sometimes there's things on there we don't even know about.
Well, and years ago, medical expenses didn't affect your credit. That changed though, right?
With the medical bills, they don't necessarily sometimes impact and affect the mortgage, but they can affect the credit score.
Right.
Because when my daughter was born, 30 some odd years ago, I owed $5,000 on her. because we had no health insurance. And of course I paid late because I was crazy like that. But it never showed up on my credit report. Now that was 30 some odd years ago. Now if that
it would
happened
just
today,
depend on if the institution has to report it. So in some cases,
Got it.
they've got to spend money to report your information to the 3 repositories.
right? Got it.
Mhm.
That's interesting.
Mm-hmm.
Yeah. So just pay your bills. If you owe it, pay it. Yes.
And yeah, look for things that you don't necessarily know about.
Yeah.
Yeah.
That's crazy.
And there's been 100 different examples of somebody moves out of an apartment complex and they have a Charter cable box that they swore that they sent back, and Charter swears they never got their cable box back,
Right.
and pops a collection on there, and it impacts their score. So there's nuisances like that you'll see a lot of times.
So let's talk about food real quick. I heard that we had a restaurant open today.
For
yeah.
lunch.
Rio Mambo opened from 11 to 3 today.
Yeah.
Yeah.
That's important.
That
Did
is
anybody
important.
fight the crowd?
Yeah, I didn't get to go, but I know
Okay.
some people did.
Yeah.
And it
Was
was
it crazy busy?
I don't know if it was that bad. No one said it was really crazy busy, but it's just,
Yeah.
I think they just opened for lunch because they don't have their liquor license yet.
Oh, is that why they didn't open for dinner?
Yeah, they're going to keep opening just for lunch until they get their liquor license.
I always have to let the new wear off before I try.
I'm like,
'cause I
I'll
can't
wait a
get
couple
in
of
there.
months and then I'll go over there.
If I
Yeah.
show up and it's an hour wait, I'm out.
I know, right?
I'll,
There is
I'll
a-
go eat a Big Mac.
There is
instead
a
or something.
luncheon Friday that I'm invited to over there, but I already have plans, so I can't go. But yeah.
We
that's
could
crazy.
send Derek
Wow.
on your behalf.
You want to go on my behalf?
Heck yeah,
I
I'll
think
be
it-
Connie
I
Little.
think it's a woman's lunch. or something.
I'm
No
not
one-
scared.
Really, Connie Little.
Free Mexican food. Hi, I'm Connie Little.
Right. And then
Got a problem with that?
Right. We have.
Maybe you could borrow her "I'm Awesome" shirt.
Yeah, I'd like to borrow my awesome shirt. It says, "Hi, I'm awesome." I bought it in the little kids section at Walmart. Yeah, funny. And then Hard 8 is coming into the Metroplex, into the Burleson area.
October, right?
Yes. They said
Isn't that what he said?
Yeah, they said fall. Yeah, so October, November. Yeah.
I think that's what Alex said, was they were anticipating October.
Yep.
Yeah. I think it's exciting that Burleson actually reached out to Hard 8, not Hard 8 reached. They were like, we want you in our community.
5, 4.
Oh, hit lock talk. There we go.
All right, and we're back. We're back on the radio,
Did we
everybody.
know what the commercial was?
Yeah, we don't know.
I don't know, but
I think it was actually
but we
a
love
song.
those people.
Uh-huh.
Whoever
Yeah,
they-
yeah. I think it was actually a song that was playing. But
Oh,
that's
okay.
Yeah, we you know what it is? You get in the queue, whatever pops up in the queue next, that's what plays.
That's what goes.
Oh, okay.
Yeah.
Well, I just want to make sure I'm doing my job and supporting the radio station as much as I can because that's
you.
very, very important.
Yes, we appreciate that.
And speaking of, if you know anyone who is looking or thinks they want to do a show, reach out to Connie, right?
Yeah, call me. Yeah, I'll give you my number. It's 817-688-5799, or you can send an email to. I don't want to give my personal email. mycommunity@gmail.com.
My community
Radio?
Radio, sorry,
forget the
mycommunityradio@gmail.com. Thank
There you go.
Yeah.
And also, if you're looking to support or do some great advertising, that she has some really inexpensive packages that you should take a look at.
I mean, it's so inexpensive. It's a tax write-off. It's $100 a month.
Yeah.
What?
It's easy stuff.
So cheap. Yeah, right?
And you get to potentially come on and hang out with us.
And this is so much fun.
I'm telling you.
There
I
you
tell
go.
you, every time I hang out with you guys, I learn something new.
I'm gonna
So
find a
thank
shirt
you.
that says "I'm awesome" and wear it the next time. I'm just telling you.
I'm gonna wear mine. I'll show you. Yeah.
Maybe we can wear it together.
Okay, let's
and
do
Derek
it.
will be left out.
Yeah, Derek.
I'll get one that says I'm awesome too.
He's awesomer.
So we're still talking about credit and the importance of credit scores, and let's talk just real quick about why it's important, the impact that can have on you. There's two impacts it can have on your mortgage, right? And the number one is your rate, and number two is, well, there's three, whether or not you can buy a house.
Right?
That's important.
That's number one. Number two would be your rate. Number three would be what down payment you're required to put down. So if you're looking at specifically just an FHA, for example, 580 plus scores 3.5%. Is that right? Did
Yes,
that
sir.
change? Okay. And then anything below that, from 500 to 579, would be 10%.
That's a big deal because
That's
you
a
know
huge
3
deal.
years ago that number was like 640 with most everybody. There's still some banks that are 620 to kind of get to that area. So 580 putting 3.5% down is a big deal.
It is. Now, is there? Does that change also for the amount that you can be approved of?
What do you mean?
So I think FHA just changed their qualifying limits. Is that
Oh,
right?
yeah, it's
Yeah.
384,000, something like that. You can buy under an FHA loan. Yeah,
And would you, if you're in the 500 to 579 range, can you?
goes the same amount. Just
Same
goes
amount?
to FHA loan limits.
That's great.
Mm-hmm.
That's amazing.
That's a lot of money.
It used to be 20% down, and then never mind.
Yeah,
I
it
mean,
did.
a long time ago. I haven't bought a house in a long time, but 20% down is what you had to.
And then
pay.
FHA, I mean, it's not a lender rule; it's an FHA rule that if your credit score is from 500 to 579, you can still buy. It just requires a 10% down payment. Interest rates are probably a point to a quarter, point and a half higher than the normal market, but obviously it's still well below the historic average of 6.4%. So you're still getting a good deal.
Yep, still really affordable, and that blows your mind, doesn't it? It blew my mind that
I'm just like, wow. I mean, anybody can buy a house nowadays. So why do they choose to rent versus purchasing a home?
that's a good question.
Fear, I believe. I think if anybody's listening and they're renting, I'd love to hear kind of the thought process, the fears that are standing in the way of
Do you feel like-
homeownership, where renting feels a bit more comfortable. Because, we all know some property managers, and it sounds like, when you go to have your credit pulled by a property manager, they're far more strict than we are on our side. I listen to some of their stories, and it's like, man, it's easier on my side of the fence than it is on yours.
I think that's true, and the difference is.
Much more selective.
Well, partly that, but the other thing is the person making the decision on the rental side of it is a person.
Right.
So they don't have the years of examining credit scores and payment histories to make that decision. They just look and see what they feel is a good credit score, and then they make the decision. And it's usually a person. It's always a person, not a machine scoring system or a guideline. And Patrick's office does a great job of taking the person and turning it into the guideline, or making everybody happy so that they meet.
Right.
But when you're just renting, there is nothing like that. So there's many times when it's more difficult to rent than it is to purchase a house. And as competitive as the market is for rentals, which is absolutely more competitive than it is for purchases right now, they're just making it's just harder and harder to get in,
That's crazy.
even with a really good rental history.
That's
So
wild. And at first and last month's rent is almost the equivalent of probably a 3% down payment on a home. If you think about it logically, I mean, based on what you can afford.
But
you
the
know?
difference is when you're buying a house, that 3.5% is going towards your equity. You're investing in yourself
Right.
in that 3.5%. The first and last month's rent's just going to the landlord. It's
Absolutely.
investing in them.
Are you surprised by the people that come in that are just not educated about the process and the interest rates and all that crazy stuff that goes on?
It's pretty wild. It's funny how you brought up the 20%. I think our team, since you brought that up, has had 3 or 4, what the term would be millennials call, and they have that thought process in the back of their mind that I'm supposed to save. I've got to wait for this 20%. We had
Right.
a conversation the other day where he was $5,000 away from his 20%. And our first question is, well, what's going on there? Is there a reason to the 20%? And the answer is always, well, I thought that's what I had.
Well, that's because
to
all
put
the
down.
baby boomers told them that's what you had to do,
Yep.
right?
Yep.
So, yeah.
and a lot of people feel that that's the responsible way to buy a house, and there's a lot more to it than just that. And is it good to have 20% down? Shoot, yeah, I think it would be great for everyone to have 20% down.
Right.
But
You don't have to.
the amount of time that it takes to save up the 20% versus the amount of time it takes up to save the 3.5% is going to allow the home prices to outpace your savings rate.
Right.
So if you wait that long, if you wait the 6 years it's going to require for you to save up the 20% down, when you could have it done in a year and the 3.5 done in a year and a half, the home prices are going to outpace your equity, your initial equity investment.
So here's something interesting. So when we were having that dialogue, this will blow your mind. So in the particular purchase price that he was looking at with his down payment investment he was going to have, it was by putting 20% down, his payment was going to be $1,555. I'm sorry, if he put 10% down now, okay, 10% down now is $1,555. But we showed if you wait, if home prices continue to grow by 5%, and let's say hypothetically interest rates grow by a full percentage point, because with the stimulus package, with the infrastructure package, with all these things that are happening, with the Fed minutes the other day, we really
Right.
think rates are going to start to see a lot of pressure. But if he waited a year, and if rates went up 1 full percentage point and the house price grew by 5%, the 20% down payment a year down the road was $15.45. So it was $10 cheaper than investing now, putting 10% down and going with the mortgage at prices and affordability at this point in time versus waiting until he thought, because he was going to get into an apartment for another year and give myself the ability to save all of this up. Well, the impact was going to be the exact same.
I hear that a lot, and I hopefully we want everyone to understand this is not a sales pitch.
Oh no, not at all.
This is
numbers.
I'm being educated.
We're talking from the heart here. When we give you these numbers, we believe a million times that this is what's best for you, and we'll help you.
Right.
We'll let you make that decision, but we want to give you the data so you have it in front of you, the real data.
Well, yeah, and the knowledge to know that people like y'all are out there. You know, that's huge, because a lot of people, when they get ready to buy a home, they're a little intimidated, especially if they don't have the background or the information going forward to purchase the home. What's the best way to do it? And y'all are there to educate them and you know, they can trust in y'all.
We always say that we're here to provide the tools necessary to make an educated financial decision. That's all that we do. I mean, it's here's the numbers. Let the numbers speak for themselves. You if they're comfortable with you, great. If not, let's create a plan and a strategy that we can get you to a level that you are comfortable.
Right.
Yeah, and when we're talking about this, it doesn't cost you any money to talk to Patrick. It doesn't cost you any money to talk to me. And as far as representation goes, 99% of the time, all of our fees on being your representative as a buyer are covered by the seller. And so you usually walk away, I mean, almost always walk away not having to pay anything for my services.
Right.
And that's really important because you want to have somebody who's on your side. I'll give you just one story I've heard recently. I can't name any names or places or anything, but there was a person who purchased a home that was listed. They went through the listing agent, and in the MLS, it stated that the property was a piece of land, was in the county, and they were outside of the city limits. And they used an agent inside that office. So there was a very small office. They didn't get their own representation on this. And it turns out while they were clearing the land, they were talking to the neighbors and mentioned it's so nice to be out of the county limit, out of the city limits. And the neighbors were like, no, that's the other side of the street.
Oh, wow.
This side of the street is in the city limits. And they're 100% right.
Oh no!
So immediately, they stopped their construction of their new house, and I don't know where it's gone from there. I'm guessing it's probably gotten legal at this point, but
So they were misled to believe that they were in the county, not in the city.
I'm not going to say that they were misled because I don't know anyone's heart in this.
Uninformed.
But they were not properly informed. Yep, they were not properly
I'm going to say
informed.
misled. Y'all can say whatever you want to. I'll say misled.
That's because you're awesome.
Thank you.
There's a lot of things that we do, and everything we're talking about. Like you can buy a house by yourself, you can, but listen to our radio show. I mean, we're spent 40 minutes now talking just about credit.
Yeah.
That's just a very small piece of the pie when it comes to buying a house, and if we can talk about it for 45 minutes to an hour, we know it's a complicated process, and it's just that really small piece.
Right.
And so when you have someone who knows what they're doing and someone who's knowledgeable and helping you through the process and someone who cares about you,
Right.
that is what is going to make a difference for you. You'll make a better decision in the long run, and it'll be better for you financially also.
Right, because you wouldn't go to a gynecologist to have them look at your eyes. Why would you?
That's a good question. Yep.
I mean, come on.
You wouldn't
Go to
do
the
I'm at a loss
people.
on that one. I'm at a loss on that one.
You wouldn't do your own brain surgery. So
Whoa!
that's greatness.
Sorry, Patrick.
We just took it to a whole new
Right,
level.
because I'm awesome. I'm
Back
just
to
saying.
credit.
Yeah, let's go back to credit real quick. So, all right, so you call Patrick, and there's a couple hiccups on your credit. So what's your next conversation? What's it sound like?
So the conversation that we would have as a group is this is kind of where you are now. Do you want to move forward now, or this is what the future could look like? So there could be any form of a plan of attack. If the credit issues are not impactful, meaning that you could increase your credit score by 30 points, but the type of loan program that you've chosen, that 30 points isn't going to make a difference to the interest rate. It doesn't lessen your down payment, whatever it very well may be. it may be a good decision to just go ahead and move forward, leave everything alone. So it would really depend upon what that mixture is, but there'd certainly be advice of here's where you are now, again, because we provide tools necessary to make an educated decision. Here's where you are now, here's where we could be, which one do you want to decide upon?
And you were talking about this earlier. You have a tool that can put together different scenarios. If you did this, how would it affect your credit score?
Yes.
And that's relatively accurate, right?
Yeah, because the cool part about our scoring system is even when we pull a credit report, it'll tell us, that this score could potentially improve by 55 points, or this one will improve by 25 points. So from that scenario, we've got a different model that we can put into the system, and the system will tell us, okay, this is what you have to do to make these things happen.
So
It's very user friendly.
That's so cool.
Oh, it's great.
And that hadn't been around forever.
Yeah,
That's,
and a lot of people don't even utilize it, and the scary part is a lot of loan officers don't even know what that number is. They'll pull a credit report and they'll see, 655, and then there'll be this little number to the side that says plus 45, and no idea what that even means or what it could do. And that means that there is some form of a system that the system will tell us that if you do these things, your score would go up by 45 points.
that's awesome.
Yep.
it's
All the
amazing.
more
You talk to
reason,
everybody about it.
Yeah, all the more reason they should deal with you.
Well, and also if that
You're
great.
smart.
if
You're
that
awesome.
45 points can affect them in an interest rate,
Save them money.
and it only is going to take them another month to get there. Yeah, that's good information you probably want to have that
Right.
Patrick's team can provide.
Or if even from the beginning, it takes, somewhere between 25 to 30 days in most cases to close on a mortgage. So you don't necessarily, you can get it locked in, you can get it secured, you can get everything ready, but you can always come back and update the scenario even 30 days down the road. There's ways that if you pay down debt, we can do what's called a rapid rescore, which is where our credit agencies will update the credit report based upon the new balances. Your credit score goes up, you get a better term, you get better rates. So all these things can happen throughout even the time from you going under contract to when you actually close.
So people don't have to not go look for a home first, right? I mean, they can go still look at a home first and then come to you and say, hey, we found the perfect house within our budget, but we need a little help getting our credit score lower.
Well, we would want to have all of that dialogue before we found the house.
'Cause you want 'em to
what the
get
impact would
pre-approved
be.
first.
You want to be pre-approved
So-
before you really go out in the marketplace looking
Don't
for
go
properties.
find your dream home
Don't
until
find
you
your
know you
dream
can
home
afford
first.
it.
Find your dream guy or gal.
Well, and there's a couple
On the
reasons.
mortgage side.
Yeah, there's a couple reasons for that. But number one is you want to know what you're getting into, and you may think it's in your budget, and it turns out it's actually not, or it turns out you could have done more and stayed in that budget.
Okay, so I have a question. So, for instance, I'm not, but I'm going to go look for a new house. So do I call Derek or do I call Patrick first?
You go either one.
Yeah, you can go either one.
Okay, and so then walk me through the process of, okay, I'm ready to buy a house, but I haven't looked at anything yet, but I want to make sure that I'm in the right place at the right time to get everything done that I need to get done.
So if you called me first,
Okay.
then we would talk about what your goals are a little bit, and then one of the first things we talk about in your plans of action is to get a hold of Patrick or a mortgage broker of your choice. I'm not allowed to steer you towards somebody, but why not use the best in the business?
There you go.
And then once that's how we're going to get together with Patrick, and we want to do it before you go look, because number one, like I said before, you could be out of your budget thinking that you can buy a $300,000 house when you really need to be down around 200, or you could actually buy a 300 and you're just unhappy with what you're seeing in the market right now at 200, but you're going to settle for it. But you may not need to. You may be within your budget to go up higher. So that's the important reason to talk to a great loan officer so that they know what's going on with your credit and your purchasing ability.
Got it.
And then what would they do if they called you first?
Well, the goal would be to get them pre-qualified first, which pre-qualified means just basically collecting your verbal information, getting permission to pull your credit. So we would go through the credit. Our team's goal is that we want to see the actual credit documentation as quickly as possible. I mean, within the first 5 days of contact, we'd like to see your pay stubs, your tax returns, your bank statements, because that's a full-blown credit approval. So a credit approval is the viewing and review and collecting of the documentation that the pre-qualification said. So it's kind of, pre-qualified is just the verbal, credit approved is actually looking at the documentation, because sometimes you can have a side business, you sell Mary Kay on the side, and your Mary Kay takes a $20,000 loss year over year because you just want to get the the pink Cadillac or whatever it very well may be. But
Right.
that loss would go against your qualified income in some cases. So we like to see if there's things. Sometimes customers will be in outside sales. I make $100,000 a year, but I tell Uncle Sam through Schedule A that it cost me $50,000 in expenses to earn that W-2. So those expenses go away from somebody's qualified income. So it's vitally important to have somebody that reviews all of the documentation and make sure that there's no quicksand traps that somebody could step into. The credit score is good. We offer the advice of, hey, here's some things that you can do to improve your credit score to get a much better interest rate. So that's when all that dialogue will happen. And once we get the plan strategized, here's how much you have to put down, here's how much you want to pay on a monthly basis, this is the type of loan program you feel comfortable with, then it kind of steers back to Derek, and there'll be a qualified price. So the consumer and Derek will know, hey, to meet these financial goals, to the program that they're at, this is kind of the loan they're going through, but they need to stay 150 or under. And
Got
that's
it.
when he'll search for the properties.
And that's happened several times with us where I would turn them over to Patrick and they're in the beginning process, and then they'll call me back and they'll say, you know what, I'm lowering my search parameters to this,
Right.
and I'm going to be a little bit more picky about certain things because I have set a goal with Patrick. I want to keep it, and it works. It works, and it's funny because when you go after it like that, when you're coming at looking for houses with more of a laser focus, it makes your decision making so much easier.
Yeah.
Right.
It absolutely will. You'll see less houses, you'll have less stress, and you'll enjoy the process so much
Right.
more.
That's called working smarter, not harder.
Oh, it's
That's right.
I mean, it takes a lot of the stress away when you're comfortable and confident in what you're doing.
Right.
Absolutely. So we've talked a little bit about credit and why it's important and how to get there, but let's talk real fast about buying and why you want to buy. Right now, the difference that your interest rate can make in your purchase. So let's just look at, you want $1,000 mortgage payment, for example. In 1985, the interest rate was 11.26%. And to get $1,000 mortgage payment, the most you could purchase was $102,000. In the year 2000, you want $1,000 mortgage payment. It's 7.38% was the interest rate required. That puts you about $144,000 purchase price. And now, if you want $1,000 mortgage payment, this does not include taxes or
it's just
anything
principal
else.
and interest. I want to make sure we say that.
Yep, just principal and interest. You can run. They're estimating interest rate around 4.16. That puts you at about $205,300. So your purchasing power is actually greater today for the same payment than it was in 1985. Now, houses are a bit more expensive than they were in 1985.
Right.
But just keep that in mind. That's what the interest rate's going to do to your payment. Top concerns of homebuyers why they're not purchasing properties right now. 29% say the inventory is too low for them.
Oh, wow.
Which is mildly true.
It is. It's been true, but guess what? This is the year that it's going to open up. Building permits are up. There's going to be more inventory available in all price brackets, and it's going to be a great year to buy. A lot of people who are worried about purchasing a home, 19% of them are worried about saving for a down payment. I think we talked about that a little bit. 3.5%, or if you want to go conventional, 3%.
Yep.
There's some really great programs. If you have military, you can get into. Is there
100% financing for veterans.
Yep, 100%.
Wow.
Yep, there's USDA loans that are out there that if you're in a rural type setting outside the city limits, and those are strategic areas that are qualifiable, there's 100% financing. If you've got credit scores better than a 640, 620-ish range, there are some down payment assistance programs that are available where state-funded agencies will grant you somewhere between 3 and 5% in order to purchase a property. So there's some great loans out there.
That's awesome. What about first-time home buyers? Is there something out there for them?
The majority of the down payment assistance programs are first-time home buyers. Some of the conventional 3% down, you have to be a first-time home buyer. The reality is first-time home buyer market is nothing more than a marketing ploy. FHA was really the original first-time home buyer program, so to say. But again, some of the grant programs, you have to be a first-time home buyer. Some of the conventional, putting 3% down, you have to be a first-time home buyer. You have to put yourself through a online education class to kind of get to familiarize yourself. But there really is not a ton of benefit that's out there because you walk in and say, I'm a first-time buyer. You don't get better interest rates in most cases. It's really just nothing more than a marketing ploy to kind of generate ideas of home.
That was a one-time deal. Yeah, your interest rate's going to be so much higher, especially on some of those grant programs.
Yeah.
Yeah.
So, but only 14% of people are concerned about rising mortgage rates. And I think that number should be more like 70%. They should be very concerned about rising interest rates over the next year.
Well, the hard part behind that is for the past 3 years, you and I have talked about, Fannie Mae, Freddie Mac economist, NARS economist, Texas Real Estate TARS economist. Everybody's come out at the beginning of every year and predicted rates to go to 5%. And I think we're kind of getting a hold of it. It's kind of, calling wolf quite a bit because it's never happened. It's never panned out.
Right.
But this is the first time we're seeing actual GDP growth that would support and substantiate some of the claims that are being made.
So listen to this. This is a great statistic. So if you purchase a home this year, you have estimated $44,905 of potential growth in family wealth over the next 5 years based solely on increased home equity. Now, those are conservative numbers, but your family's wealth could go up by $44,905 in only 5 years.
Wow.
Based on predicted housing prices. And that kind of leads to this next statistic. A homeowner's net worth is over 44 times greater than a renter's.
That's crazy.
Those are...
Because home appreciation
Yeah,
and
that's awesome.
and equity acceleration. Each
That's a
time you're making a
savings
payment, you're paying towards the principal.
Yep. An American family's net worth is, on average, $231,400 as a homeowner and $5,200 as a renter.
That's a crazy number.
That's a horrible
That's
number.
a crazy number.
That makes my stomach hurt.
That's like you invest into your 401k for your retirement. This is your retirement plan, your home.
It's like a forced savings account.
Yeah.
That's the greatest part is in state of Texas law, we require 20% equity at all times. So it's an area where you can't go in and grab it. It's you can't have it until you go to sell it. And then when you go to sell it, with Derek, you're going to have a big old huge check that you weren't expecting. So, it's
That's nice.
it's a good deal.
That's funny because that's number 3 on my 5 financial reasons to buy.
Look at Connie and I. We are awesome.
Y'all are
We
awesome.
are. We
I'm
need
going
to-
to buy your
You're right
t-shirts.
there.
We're getting shirts.
You're all over it. You're right on it.
So, reason number 1, housing is to buy. Housing is the one leveraged investment available. Homeownership allows households to amplify any appreciation of the value of their home by a leveraging factor. Can you explain that to the average person? Do you kind of understand what they're saying there?
You're able to improve the property. Okay, you're able to add additional principal payments if you want to. You have more control of the financial asset than you do if you go buy a stock. If you go buy a stock, I can't do anything that General Motors. I can't make a decision for General Motors. I can't make a decision for what they do that could impact the stock on a positive level, but they could make decisions that can impact it on a negative level. I'm an outsider looking in as a stockholder. As a homeowner, you're in 100% control of where that asset goes, how the asset improves. If you buy a property that needs a little bit of TLC, and it doesn't necessarily appraise for what you were thinking, you could go in and update the kitchen, you could paint, you could add different features that adds to the overall value. So it puts you in a greater position to control the asset as it grows.
So you're the CEO and the board of directors for that investment, and you get to control what happens to it.
And you're in control of paying it off
Absolutely.
as well, which creates equity and assets.
Yep.
Right.
So number 2 is you're paying for housing whether you own or whether you rent.
Sure.
And you're going to pay the mortgage for your landlord, or you're going to pay your own mortgage.
Well, the way the terminology is always you're investing in yourself or you're investing in somebody else. That's the way to look at it. By a homeowner, you invest in yourself through principal payments. As a renter, you're investing in somebody else.
Right.
And then, as Patrick said, owning is usually a form of forced savings, which we kind of covered.
Good job.
Did you see that?
See how he says that?
I didn't even read that.
I know. And there
I
are
didn't even know that existed. In a slide.
there are still some number 4, some substantial tax investment benefits to owning a house, unless you are in the 0.5% of the 1%. You know, I think
Buying over 750, you can't utilize it all.
right. So you're still doing fine
Yeah.
as the average person. And then finally, owning a home is a hedge against inflation. Your house is going to go up as inflation goes up, and your payment's going to stay the same or go away. And that's the great thing. Your cost of living is going to go down as a percentage of your income as long as you're locked into a fixed mortgage, a fixed rate mortgage. It's the only way to go. And that takes me down to the top 3 reasons that people want to own a home. That's because they want the opportunity to build equity, they want a stable and safe environment, and they want the freedom to choose their neighborhood.
Yes, they
And
do.
so
Location.
Yes.
so freedom's what it's all about. If I had
Yeah.
an Uncle Sam hat, you know, I'd put it on right now because
Freedom.
this is America,
I
folks.
was thinking Braveheart.
Oh.
Thinking
We're all
Derek
going to
Laidback.
break into song.
Yeah, huh? So I didn't go that way. I went the other way. I was the kilt and everything.
That's so funny. My dad, I've got
I had
a
a
friend
visual.
who is not Scottish, or not from Scotland, but every time he goes out now, he wears a kilt and a jacket.
We're gonna.
He's
when
getting
we
older.
wear our awesome shirt. That'll be your costume for the day.
I'm gonna wear a kilt. Yes, I will. If I get an awesome shirt, I'll wear a kilt. I'm in.
That'll be you for the day.
I love it. I love it.
I could have one on right now and nobody knows.
I know, because I'm sitting right
Oh,
next
that's
to you.
true.
That would make it awkward.
Well, that we'll wrap it up on an awkward note. Then I hope this helps everybody. Patrick, how can they get a hold of your team?
Area code 817-945-2551 is the office line.
Perfect. And then again, Derek Taylor. My email is derek@derektaylorrealty.com. You can find me on the internet at that same address, derektaylorrealty.com. Or you can look at our Burleson site, which is burlesontexashomes.com. And you can always call me or text me at 817-637-2249.
And if they follow the Facebook page, could they later ask questions and we can jump in there and answer them at a later point in time? Is that right?
Yeah, absolutely. Yeah, as you're watching this is going to stay evergreen. Feel free to jump on and ask questions, and we will go through them and look at it and get back to you on any of those questions. We'd love to talk to you.
Perfect.
Y'all are awesome.
You're awesome. Thank you for being with us.
Sure, I learned something new today. I'm good.
You brighten it up.
Thank you.
This is true.
Thank
Well,
you.
that's all, everybody. We'll see you next week, Tuesday at 5 p.m. Thanks again.
Beautiful.
Lock talk. Off. Nope. Q. Nope, not that one. Right here.
I thought you had it down, man.
And then
I
go
thought you
up
were
to
good.
Auto DJ. And then go to Deck B, Desktop B, over there in the middle. Yep. And then click on your encoder, click on there, and then hit that circle. Stop. And then go back to A. You're done.
We did it.
And then you just want to make sure that you can hear the music playing through that speaker.
Thanks, Facebook. I'll let you guys go to